Welcome back. ExxonMobil is trying to stop a planned merger between Chevron and Hess. That deal expected to close within the next year. I spoke with Chevron Chairman and CEO Mike Wirth here yesterday at the Milken Global Conference.
This is a good deal for shareholders of both companies. It's a good deal for the industry. It's a good deal for the country of Guyana. And we're very confident that the deal will close. We're working our way through the FTC process, which we expect to be concluded by the end of this quarter, shareholder vote at the end of this month, and then we've got a contract issue with one of the other partners that will be resolved through arbitration, and that'll take a little bit longer.
So I want to really get your take on what Hess brings you. Obviously, Guyana is a huge project, the biggest, and that's the superstar of that deal. But tell me what else Hess brings to the table for Chevron.
Well, I'll start with the people, really good, quality people, and a culture that aligns with our culture. And it's a tribute to John Hess and the Hess family to have created a company that has such a commitment to safety, to integrity, to protecting the environment and doing the right thing. So great people. They've got a great portfolio of businesses. So we've got some complementary businesses in the Gulf of Mexico. They've got a strong position in North Dakota where we don't have anything. And then, of course, Guyana is a tremendous asset as well. So it's people, it's technology, and it's these great assets. And the combination will create a premier energy company that'll be good for our country.
It sure would. I want to get your take, though, on what Exxon is saying about it. They claim they have first right of refusal. They're trying to stop this deal. What do you want to say to Exxon, given that they have their own partnership right now with Hess, as does CNOOC?
Yeah, we worked and Hess worked to try to understand Exxon's concerns and address them for a long period of time before this went to arbitration, and we thought we were making progress and being responsive to their concerns. They then concluded that it was better to put this through the arbitration process, and so those discussions have come to an end, and we're really now headed towards resolution through arbitration.
And because of that arbitration case on Friday, Hess said that this deal is likely delayed until at least 2025. Is that what you're expecting?
Yeah, it's hard to know exactly what the timeline will be because that's set by the arbitration panel and the arbitration process. We're hopeful that it's faster than that, but ultimately that's something that we have some measure of input to, but certainly not control of.
Tell me what drove the most recent quarter.
We had really strong performance operationally, largest production in the history of our company and in the U.S., up 35% year on year, which led to strong financial performance. Our 8th quarter in a row over $5 billion in earnings, and distributed over $5 billion to shareholders for the 9th consecutive quarter. So strong operational performance, financial performance, and strong returns to shareholders.
And shareholders want to know that the dividend and the buybacks will continue. What are your expectations? Dividend
was increased 8% earlier this year, making 37 consecutive years of dividend increases. Over the last 2 years, we've distributed 17% of our market cap back to shareholders through dividends and share repurchases, and we've got a history of prioritizing those, and I think shareholders expect that to continue.
Mike, let's talk about the growth away from this deal. I know you've got your enormous project in Kazakhstan. That expiration is coming up, right? You have to renew it?
Concession runs for another almost 10 years. It expires in 2033. We've got a large project underway right now to take production from 650 or 700,000 barrels a day to 1 million barrels a day. We've begun the startup of that with some significant news this last quarter about compression and conversion of the field to operate at lower pressure, on our way to a full startup of that incremental capacity in 2025. So it's an important part of our business and important supply to Europe and to the world.
What's Plan B if the Hess deal does not happen for you?
Well, we had a really strong portfolio ex-Hess. So the Hess deal makes us even stronger, but we're delivering 10% compound annual growth in free cash flow over the next several years, a 3% compound annual growth in production, driven by the Permian, driven by some other shale assets in our portfolio, projects in the deep water Gulf of Mexico, one of which is scheduled to start up the middle of this year, and then several that will follow that. Big position in the Eastern Mediterranean, offshore Israel. So we've got a number of other assets that are delivering growth, and the combination with Hess only strengthens our cash flow longer into the future, not only to the end of this decade, but well into the next.
Mike, I'm glad you mentioned Israel because obviously we've got two wars underway. Israel and Iran are this close to a wider conflict. How do you view that in terms of the potential for upsetting production?
Well, we did see some impact on our supply of natural gas into Israel during the early days of the conflict. We now have both platforms online and are meeting all the needs, not only for Israel's domestic market, but also for Jordan and Egypt, where the gas goes as well. So right now, we're operating well. We've seen disruptions to shipping in the Red Sea. We've had some disruptions last year in the Arabian Gulf. And so the risks in a situation like this are that through some sort of an escalation, a miscalculation, that you could see impacts on physical supply in an area that supplies so much of the world's oil. And that's a real concern.
It's a real concern, and I think it's the reason that many people expect oil prices to stay elevated. What's your expectation?
You know, it's really hard to predict oil prices. We prepare for volatility. We've got a balance sheet that allows us to withstand a period of very low prices for a long period of time. Right now, we're seeing prices that have been kind of in the $80 to $90 range here for quite some time. Markets are relatively balanced. Demand growth is strong. Last year was all-time record demand. We'll see demand grow again this year. So the end of the oil age is not yet upon us. And in fact, it's important that we continue to meet that with new production, which is certainly what we've been doing. In the short term, these risks due to geopolitical events are things to pay attention to because they could impact markets.
How would you characterize demand globally right now?
Continuing to grow. We're seeing demand growth in the U.S. We're seeing demand growth in Asia. Europe, less so, but you know, the U.S. and Asia are really the two big drivers of global oil demand and demand growth. And look, the U.S. may not be growing as fast as it was a year ago, but it's still growing. China has recovered from where it was a year ago and looks to have stabilized. And so, you know, global demand was up about 2 million barrels a day last year, year on year. This year, we think it's going to be up about 1.5 million. So still strong growth in oil demand.
We'll have a lot more with Mike Wirth. We will have part 2 of my interview with the chairman and CEO of Chevron tomorrow right here. Join us for his commentary on U.S. policy and oil prices longer term. That's tomorrow right here on Mornings with Maria.